Welcome to Fomo Consulting for your daily AMC stock analysis video on Saturday, May 8th. Ladies and gentlemen, history is repeating itself, and I'll show you why very shortly. And as always, the apes are winning, the diamond hands are winning, and certainly the retail investor is winning. So if you find this video informative and entertaining, please like, share, comment, and subscribe. It is a newer channel, and I would certainly appreciate the support. Let's get into the video. So I want to thank everyone again personally from the bottom of my heart that has liked, shared, commented, and subscribed. It means the world to me, and thank you from the bottom of my heart. Start with a quote. Where there is no struggle, there is no strength, by Oprah Winfrey. Certainly a very successful woman, right? We have certainly gone through our struggles. We continue to go through our struggles, but in that process, we are finding strength, we find resolve, and we find purpose. So I think this is very relevant. So broader market ending yesterday, very bullish, very positive, good recovery to end the week. It was a pretty rough week, especially in tech again, but overall very positive. Three major indices all green today, which was good to end the week. Trey would be very proud of his George W. Yesterday, it spelt win on the 1 minute chart. Very impressive. So overall, the AMC stock followed the broader market in general, but who cares? We closed at $9.51. The last green candle was a game-winning shot for us, and it was certainly an exciting 3 or 4 minutes. So congratulations to everyone. We closed at $9.51. Finally had a green day, up 5.67%. Overall, the indicators seem to be trending back towards a bullish direction. We've certainly taken a hit over the last 7 or 8 days. Obviously, with the 17 million shares hitting the market, the shorts were certainly capitalizing on that leading up to earnings. Not concerned one bit. I do believe we will have a bullish green week this upcoming week. When in doubt, zoom out. Still trending upwards. No problem in my perspective. Again, I'm not a financial advisor, not financial advice, but I certainly believe we are heading in the right direction, and we are going to continue our upward trajectory. So what I want to show you today regarding history repeating itself. So this is the NASDAQ chart going back nearly 2 decades. So I'm sure everybody has heard, lived through or been a part of the tech bubble that you've heard about. Specifically coming up recently, a lot of tech retracement over the last couple of weeks or so. So let's look at the chart real fast. So the first orange bar is the high point of the tech bubble, 1999, 2000. Some of the younger listeners may have not even been alive at that time, but certainly a lot of run-up, a lot of excitement, and then the bubble burst, right? It took nearly 15 years for the NASDAQ to recover after that tech bubble burst to regain its previous pricing level. Since that point, as you can see, we have shot up, and we are clearly over $14,000 right now. It did not take long, so it took nearly 15 years to recover. Since that point, we have skyrocketed by actually more than double. So very, very bullish in the last 5 years or so, but the tech bubble was a big deal. So let's look at Amazon from its inception. Certainly felt the tech bubble burst. As you can see, orange bar on the left. Red line is basically the height of the pricing at that time. It ran up to about $110. Not bad. Started out, wouldn't you have liked to invest at $1.31 in Amazon? I certainly would. So the second orange bar on the right you see is the housing crisis collapse. So what does Amazon have to do with the housing crisis, right? Every stock was affected in 2007, 8, 9 by the housing crisis, without a doubt. In every sector and every segment of life. Bad days. But Amazon certainly felt the effects of that tech bubble, albeit it was not a death sentence by any stretch, certainly. So there is hope even in bad times. So, housing crisis. And I've showed a couple of these before, but some of the newer viewers, younger viewers, may have not been paying attention or cared at the time or even been alive. This is Citigroup. So when the housing crisis occurred, this is the weekly chart. You can see it absolutely fell off a cliff. It was trading around $570 at its height and went down to $9.70. That is how bad it can get when banks collapse, when things are not in a good spot from a regulation standpoint, which is why the last few weeks and the next few weeks are going to be so absolutely crucial, not only to the economy, but also to the financial structure. Here's AIG, involved again with the housing crisis, trading almost over $1,100, fell down to $5.35 at the bottom of the housing crisis. JP Morgan, very essential, and I'll tell you why here very shortly. You can see fell off a cliff. They were trading around $52 at its height before the housing crisis. They went down to 90 cents. Absolutely incredible. Those were bad days, and in a lot of ways, this has fueled the current movement around hedge funds and around banks and around free and fair trade, and certainly that left a lasting legacy. So let's look more recently at Viacom. So Viacom was tied up in the Archegos margin call. If you recall, that was a family owned business. They were not a hedge fund, but they were leveraged almost 5 or 6 times over. They certainly had a lot of concentration in really 2 stocks, Viacom and Discovery. So you can see it was a pretty good run, and they were long. They were not short, which is why the stock fell off a cliff, as you can see. Here's Discovery. Margin call, same day, fell off a cliff. Again, that family fund was long, not short. So the inverse may very likely happen based on the heavy shorting of AMC, GME, and others. So let's look at a little bit of DD. So this is around Bear Stearns. You can get this off of Wikipedia anytime. So Bear Stearns, for some of the younger viewers again, Bear Stearns was essentially the citadel of its day. It was a clearinghouse, it was a hedge fund, it was an investment bank. It was certainly front and center of the housing crisis. They had at one time in 2006 total capital of approximately $66 billion, total assets of $350 billion. But most importantly, they had $13.4 trillion in derivative financial statements, of which $1.85 trillion were listed futures and options contracts. The $11.1 billion supported by $395 billion in assets, which means a leverage ratio of 35.6 to 1. Archegos was what, 5 to 6 times leveraged? We don't know how leveraged some of our competitors with AMC, GME, and others, how far they've leveraged themselves. But it's pretty clear that 5 to 6 times would be a reasonable assumption. Moving on. So Bear Stearns pledged a capitalized loan of up to $3.2 billion to bail out one of its own funds. They started negotiating with other banks to loan money against collateral to another fund, Bear Stearns High Grade Structured Credit Enhanced Leveraged Fund. Bear Stearns had originally put up $25 million, so they were hesitant about the bailout. Nonetheless, CEO and senior executives were worried about the damage to the company's reputation. Poor babies. The funds were invested in thinly traded collateralized debt obligations, CDOs. Most importantly, Merrill Lynch seized $850 million worth of underlying collateral, but was only able to auction 100 million of them. That's very important. Coming back to the Archegos situation, this is why all of these rules are quickly being implemented. They are scared to death because they know these banks are over leveraged. The margin debt is out of control. It is clear on charts. You can do your own DD with that, but that's essentially a margin call before the housing. So out of this article, Merrill Lynch loaned Bear Stearns 90% of the face value of the collateralized debt obligations sold to Bear Stearns hedge funds. Moving down, in June, the Bear Stearns hedge funds, which eventually liquidated, sold $3.8 billion of CDOs to meet margin calls by Merrill and other lenders that were following its lead. The fire sale led to a further drop in CDO prices, which again starts the chain reaction, right? So this NSCC Rule 006 was passed yesterday. Essentially, in summary, it's a 109-page document, or it's a very long document. But it basically, and I read, NSCC is proposing to delete a requirement in Rule 33 that members and limited members be given 10 business days notice of any proposed amendment to the procedures. NSCC is also proposing to replace immediately with promptly in Rule 36 in order to provide that NSCC will promptly, but might not immediately, notify members and limited members of any proposed rule changes. So essentially what that's saying is they can implement rules as they see fit without having to do the 10-day waiting period, which would in turn kick the can down the road further, which is why I believe a couple of the regulations were kicked from yesterday down the line, because I think they wanted to get this in place first, so they have the arbitrary authority to implement rules at a time that they see fit. Again, it was passed and it is implemented and likely will be approved by the SEC. So if anyone's ever played the game Jenga, I certainly believe that is what is occurring now. Very simple kids game, but one block at a time, right? You try to remove one little block at a time, very slowly, to keep the tower from collapsing. The rules and regulations that are being implemented very systematically, very strategically by the SEC, DTC, and SEC is very relevant, because they know the ivory tower that our opponent is sitting in is going to collapse. It's only a matter of time because of the margin debt, because of the widespread manipulation and everything going on. They are trying to protect the financial system, the economic system. I believe this affects not only domestically but also internationally to the United States. A lot of offshore trading and what have you. This could be way more systemic than we can ever believe. And again, as I showed you from the tech bubble to the housing crisis, how bad this can actually get, they are trying, in my opinion, to very systematically stave off a huge financial crash. And kudos to them for doing so, because anyone who lived, worked, or was affected by the housing crash, those were not fun times or good days by any stretch of the imagination. So let's look at what we already know. So this is a screenshot off a website, how the media goes against the sentiment and the technicals, which we already know, right? A lot of hit pieces. But it's funny that the blogger opinions for AMC are certainly bearish, right? But the news sentiment over the last 7 days has become increasingly bullish. Technicals are improving and will continue to do so. So media buzz over the last 7 days, AMC is certainly heading in a bullish direction. The news sentiment, however, is behind the market sector that AMC is in, and it's coming out of a very bearish perspective, as you can see. So we're 60% bullish, so the tides are turning. I believe we'll see, now that we're past earnings, I believe we'll see improving media coverage. But this is an interesting little chart, how the media sentiment, the blogs, everything affects the price. So you can clearly see the price is the top of the blue chart, obviously. Neutral news is the gray bars. Bearish news is the red, and bullish is green. So it would appear that obviously the more bullish, better the price, right? But you can certainly see the wider bands more recently of the bearish news. Obviously, we know about all the hit pieces, but it's an interesting perspective. So this is a breakdown of all of the bearish people that keep knocking us around in the media, right? The bloggers and opinions. Investor Place is responsible for 46% of article distribution. Seeking Alpha, 30%. The Fool, 18%. 6% others. We already know that those are the main culprits that keep putting out the FUD to try to shake the shares from our hand, but it's an interesting perspective. But you can see with those blog articles, we are distinctly bearish versus the rest of these stocks and companies in our sector. So I thought that was a very interesting perspective, and there has been 49 blogger opinions of recent, which is, again, very, very high level. So this is a little bit of a highlight from a research article around short squeezes from January 2011 to March 2014. It was a 98% sample size of 3,000 plus stocks. They had an observational identification of 346,000 potential squeezes. However, when they put up a certain amount of criteria, which are out of the money percentage, which is basically the sum of shares experienced losses, out of the money percentage at a 20-day max, short position profit concentration, earnings announcements, 5 days up to and 3 days after, positive news events, abnormal trading volume. With that set of criteria, it shrunk those short squeeze parameters to a more manageable size from a scientific perspective. That essentially during that time gave you 3,200 short squeezes with the criteria below. That is 251 short squeezes per quarter. I thought that was interesting, and quite frankly, I like those odds, but do your own due diligence, but I believe that the odds are certainly in our favor. So I showed this yesterday, and I've shown this before, but I've continued to do some additional research. So what you're looking at is obviously this is MVIS, popular stock of recent. The trend lines, the orange and red trend lines specifically, are the short interest trend lines of shares on loan and free float on loan. And as you can see on the left green arrows, when you have and this is my own personal hypothesis and own research, when you have a major divergence in the price action versus the shares on loan and free float on loan, the price finds its way to those levels shortly thereafter. As you can see with MVIS, you get the orange bar, that's the levels of the shares on loan and free float on loan. The price finds it exactly. You go to the second one more recently on the right, you get the shares on loan trend line, the price finds it or exceeds it every single time. So this is GME, and I showed this yesterday. Trend lines leading up to major divergence between price and shares on loan. That price will find those trend lines. GME was obviously cut short, as well as AMC and others, due to the buying at the during the short squeeze in January. I do believe it would have exceeded $700 a share based on what I'm seeing. But more recently, the nice little pop we've had in March, you see a major divergence between the trend lines and the price action, getting the pop. So another popular stock, did a little more research. This is Palantir, PLTR. So you can see where major divergence between price action and the shares on loan, the price quickly ran up to find that level, as indicated by the yellow bars and the red X. This is Rocket. So Rocket popped about a month or so ago. As you can see, short data trend lines, shares on loan, free float on loan. Well, wouldn't you know it, the price found it to a T at $43. Again, I can't prove this about every single stock, but it certainly seems to be a trend in the analysis. And here's our baby AMC. Before the baby squeeze, he had a big divergence. You had another one in early March, late February. You had another one in mid-March where we ran up to $14. The price called up right to the trend lines. Now, if you look at the major divergence between price action and the short data, the short trend lines of free float on loan and shares on loan, I believe we are poised to pop sooner rather than later based on my own due diligence. Do your own, please, and let me know your thoughts. Before the baby squeeze again, this is exceptionally important to keep showing this, because before the baby squeeze we had around 50 million shares borrowed. We now have 3 times that amount at 150 million. Absolutely huge. Speaking of shares on loan, yesterday market close, our opponent has 4.67 borrowed shares in their possession based on what they returned. I have no doubt they're going to use them next week unless the rules and regulations force them to cover. Short data all continues to trend in a very good direction. Probably the most telling thing is the days to cover that keeps increasing rapidly. We sat below 1 for quite some time. Once we've crossed 1, now we're at 1.64. Again, I believe it's 3 to 4 days, depending on how you calculate it. But institutional investors keep piling in. The short borrow fee on Fintel, 26%. That's a 15% jump just from yesterday, or actually earlier in the morning. So 100% utilization, everything is trending, nothing has changed. This is poised to squeeze. All we need is some sort of catalyst to force the price action upwards. And as always, I have skin in the game. I'm winning with you and I lose with you every single day, diamond hand to the end. Last quote. It is Saturday after all. Friends are the bacon bits in the salad bowl of life. Homer Simpson. Who doesn't like Homer, right? I do believe that everybody in this community and others, and everyone that is involved in AMC, GME, and others that are part of this movement are all in the bacon bits in our salad bowl of life, in our salad bowl of this movement. And my only hope that comes out of this, the lasting legacy, would be that we all have a better salad bowl for the rest of our lives. So as always, I want to thank you for watching. If you found this video informative and entertaining, please like, share, and subscribe, as well as comment. It is a newer channel, and I would certainly appreciate the support. As always, have a great weekend, and I hope your life is full of green candles. We'll talk to you soon. Bye-bye.